Ladies and gentlemen, good day and welcome to the Q2 FY25 results conference call of Shri Keshav Cement and Infra Limited, hosted by Kirin Advisors. As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jainam Salva from Kirin Advisors. Over to you, sir.
Good evening, everyone. Thank you. On behalf of Kirin Advisors, I welcome you all to the Shri Keshav Cement and Infra Limited Q2 FY25 conference call. From the management team, we have Mr. Venkatesh Vatva, Executive Director and Chairman, Mr. Srinivas sir, Senior Finance Head. Now I hand over the call to Mr. Venkatesh sir for the opening remarks. Over to you, sir.
Yeah, thank you, Jaina. And good afternoon, everyone. I'm Venkatesh Vatva. I'm the Chairman of Shri Keshav Cement and Infra Limited. I welcome and thank you for this conference call of SKCL. We are delighted to have each one of you here, and we explore and discuss the financial performance of second quarter of FY25. So before we get into the details of this quarter, I would like to give a brief overview of the company and its robust business model. SKCL, what was known as Katwa Udyog Limited, is engaged in the manufacturing of cement and generation of renewable power in solar. And cement is sold in North Karnataka, South Maharashtra and Goa, whereas power is sold in the entire North Karnataka region or even other parts of Karnataka. The company has a network of over 350 distributors with around 600 retail touch points and around 14 solar power consumers. So since 2018, the company has been meeting 100% of its energy requirement through renewable solar energy. The cement plants of SKCL are likely the only ones in the country to run on 100% grid power, or at least we were the first company to do so, resulting in a significant reduction in the power cost, which is over 75%. We also received an prestigious awards amongst many. One would stand out is from Bureau of Indian Standards for 3 years of consistent high quality cement and zero product failures. We are pleased to report significant start in FY25 marked by key advancements that underscore our commitment to sustainable growth and financial stability of the company. One of the significant milestones this half year is the commissioning of additional 3 megawatt solar plant at Bisirali in Karnataka, which brings our total solar capacity to around 40 megawatt. This expansion highlights our decision and dedication to focus on renewable energy and reinforces our environmental responsibility. In addition, we also secured a good credit rating upgrade from current to IVR BBB stable outlook. IVR BBB minus stable outlook on facilities obtaining total of 223 crores. These achievements reflect our focus on sustainable practices and financial strength, and we look forward to building on this momentum for continued progress and value creation for our stakeholders. So let me take you through the performance of Q2 and H1 FY25. Q2 FY25, SKCL reported a total income of 25.36 crores, demonstrating steady revenue generation in challenging market landscape. The company achieved an EBITDA of 3.04 crores, translating into 12.44% EBITDA margin, reflecting our ongoing efforts to enhance operational efficiency. For the first half of FY25, the total income reached 56.6 crores with an EBITDA of around 11.11 crores, resulting in an EBITDA margin of 20.23 crores. So looking ahead, we are poised to harness further advantages from economies of scale as we work towards tripling our plant capacity, achieving higher utilization rates, and expanding our solar capacity. These strategic enhancements, combined with the favorable demand outlook of cement, are set to significantly bolster our performance. Our goal remains to steadfast to drive sustainable business growth and reinforce our market position with a strong emphasis on elevating our brand's presence and value. To generally speak about the cement industry, first 2 quarters, Q1 and Q2, have been pretty sluggish on a trail of completion of a major election in India and then followed by monsoons. However, in spite of these challenges, the company has increased the dispatches compared to the previous periods. So this fiscal would again see the infrastructure and affordable rural house segment to propel the growth. The highest traction is expected from roads, where the total outlay from the Ministry of Road Transport and Highways and National Highway Authority of India has risen 25% and 14% respectively year-on-year. So top industry analysts and cement market leaders expect about 7 to 8% growth this financial year of FY25. Considering the first two sluggish quarters on account of election and monsoon, the next quarters are expected to deliver significant cement demand due to stabilizing of central government and prime focus to spend on infrastructure. Pradhan Mantri Awas Yojana, announced in June 2024, is a significant scheme to build around 3 crore housing units. Construction provides one of the highest direct employment and will be our focus for all the political parties, which will drive the growth of cement. So based on this, we are optimistic on demand outlook and expect a strong growth in the coming years. So with this, I'll be happy to address any questions anyone would have had. Thanks a lot for the patient hearing, and I'm open for the questions right now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bharat Gupta from Fair Value Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. A couple of questions from my side. So while we understand it's been a weak set of performance, particularly, can you just help us or give further colors regarding the EBIT loss which we have reported in the solar side as well as on the cement side?
Absolutely. So, solar did not suffer any EBITDA loss, or rather reduction in EBITDA, mainly because solar is consistent on generation and pricing. As typically expected, solar has been giving the financial boost in the company for last many years, which is why we have taken up the work on debottlenecking of cement plant so that cement and solar together can run like a double engine circuit. But nevertheless, coming back to solar EBITDA, for example, in Q2 we achieved a solar EBITDA of around 7 crores. However, cement gave a negative EBITDA because of a significant drop in the pricing. So, for example, in H1 of this year compared to H1 of last financial year, even though dispatches increased by a significant 10 to 11%, the prices also decreased by around about 10 to 11%. In spite of having such a bad market, and we are able to keep expanding our footprint by going deeper, which is why our dispatches have gone up. But basically, which is conditions of cement dispatches all over nationally, if you look at anyone right now, has been very, very negatively impacted due to, like what I mentioned, the elections and the ensuing monsoons. So hoping that, assuming that 7 to 8% growth is intact based on the top analyst review by many analysts, in fact, cement specialists, we're hoping Q3 and Q4 would make up for the loss of Q1 and Q2.
Right. Sir, in terms of the overall realization which we witnessed, so can you just quantify the number for the current quarter and for the H1?
You're talking about the net realization for cement pricing?
Right.
So in Q2 of FY24, we have net cement realization of around 3,710 rupees, but right now it is 3,290. This is a net realization excluding everything, ex-plant, excluding, of course, taxes and any kind of logistics or so this is what it is. If you look at it, almost 400 rupee, reduction would mean that the top line has reduced by almost 12%.
And sir,
however, the dispatch is
reversal out there in Q3.
So Q3, what we have seen is the price have stabilized. What we have seen as in from Q1 to Q2, the price kept sliding. For example, I'll give you a rough estimate. Q4 of FY24 price was 3,070. Q1 was 3,480 and now 3,290. So this either has stabilized or started to show a little uptick, but it hasn't grown any significant as of now. And if you look at the national news, typically this is the same pattern all the cement plants are going through. It is just that we are expecting the government to begin spending on infrastructure, which is a significant contributor. And due to elections in Maharashtra, as well as most of the one of the biggest spenders in the country is Maharashtra, which is where the infrastructure stock has been slowed down due to the local elections out there. But we are hoping from next month onwards, at least the analysts saying that Q3 will end with a good demand and Q4 is going to take an upward trend in dispatches.
Right. Great to hear that. Sir, with respect to the plant commencement, so can you just give us colors like what's the update with respect to the new enhanced capacity?
Sure. So as of October 3rd, we have completed the entire plant. In fact, technically, we have completed all the civil and mechanical work. So this new plant will require a higher power connection, which is right now we are on a 33 kilovolt line. We will need a 110 kilovolt line, which are supposed to supplied by the government. The infrastructure which is supposed to come up, 2 to 3 kilometers from our plant, that got delayed from the government side. So that was supposed to come up about 3 to 4 months back, which is what we were hoping on. So now we were told that the issue has been resolved and that power station will come in next 1 month or so. So once that comes up, then we will be able to start upon new machinery. Otherwise, as of now, the entire machinery as well as the kiln is ready. Only little boxing up is going on because since we knew the delay has come in, so we are making sure the boxing up is coming to the final stages. As such, the plant is ready. It's just that because of power, we have to wait for some more time.
And sir, we expect the incremental amount of revenues to come in from FY25 onwards only, FY26 onwards only.
Yeah, we are hoping to start from Q4, but realistically, FY26 will be full first year with the entire year dedicated to the new capacity.
And
otherwise,
right.
Please go ahead.
So in terms of our overall guidance of achieving a EBITDA of 80 to 90 odd crores in FY26 and to a range of 120 to 150 crores in FY27. So are we sticking to it currently? And these numbers which you have quoted in previous calls, so that is based on what kind of a cement realization?
So that is considering the price what we had in FY24 and taking an incremental growth at around only 3% of growth in NCR. Generally, we are very conservative when we talk about the cement pricing and little more easy on the costing. So we have taken only 3% increase in our calculation for the price growth. In fact, the last year, for example, the average price was around 3,800 or so, the net cement rate. Unfortunately, the first 2 quarters are pretty bad. So hoping that end of Q3 and Q4, if they add up and we go back to what we achieved in FY24, and then take a 3.5% increase from there, about 100 to 115 EBITDA should not be very far-fetched idea.
So in a way, we are sticking with our guidance which we have done earlier, which we have mentioned earlier.
As of now, yes. Because with the top analysts giving a very good picture on cement for next. See, typically what happens, we have seen this in the past, many years back. When there is a dip in cement consumption, the capacity what is unused, or rather that demand does not go off. It has to come back again in a extreme high demand, as an extreme high demand case. So a lot of projects which have been slowed down or stopped. The thing is the demand has not slowed down. So what happens is for them to catch up, the demand suddenly increases. This is what we've seen in the past generally. Typically, before when the monsoon is over, we see that uptake happening. Unfortunately, not this time, but that is the trend we have seen in the past. So we will stick with this guidance as of now.
Right. And sir, in order to meet out with respect to the excess amount of production which we'll be doing, so have we hired any kind of what has been the hiring in the overall sales force and in terms of addition to the distributed network? So can you give further colors like how you are planning for ramping it up at the earliest?
Sure. As of now, in fact, we have already hired additional sales and marketing people. In fact, we have begun to hire it from beginning of Q2 itself, which you can see the employee benefits and everything has taken an uptick. What we are doing in spite, see, if you look at a national character on the cement consumption, it has gone down. In our case, it has gone up. The dispatches have gone up with such a stiff resistance of market. We are just hoping that once the market opens up and the demand shows up, then there is a very high trajectory of growth. So as such, now we are, meeting a lot of new people, new dealers, connect with the institutional buyers. Since most of the government contracts are not beginning to done right now, but we have got clearances from various departments. Quality departments have given clearances to our cement to supply when there is a project going on. So such things are happening. But like I mentioned, the moment there is an uptick, it will all start panning out.
Right. Last question, if I'm allowed. Sir, with respect to the gross debt, it has increased to 235 odd crores at a time when we are yet to commence our operations in a way. So, do we expect a further increase in the overall leverage position going forward once the new capacity comes? And can you just give us an idea about the debt repayment schedule?
Sure. You're talking about debt of 235 crores, right?
Right.
Which has reduced to around 2 to 23 crores as of September. And as such, first couple of years, we will continue to service the debt as per our repayment schedule. But once we have enough profits generating and cash generating, management will look forward to cutting down on debt and prepayment so that the debt burden will start coming down.
All right. So the actual repayment of the full long-term debt, it will start in when, in which fiscal year? If you can provide some clarity with respect to it.
So all the debt that we have, except the one which we have taken recently for this capex, is being repaid since last from whenever. I think we started taking a debt in 2017, and the last debt we took was in 2023. So the debt which we have taken in 2023, which is for this capex, will begin the repayment from October 2025. So we are still 1 year down to go for that. Otherwise, every other debt, I think from now 7 to 8 years, it is supposed to get over. Some debt will get, for example, the debts what we are taking in 2017 will get repaid in next 6 to 7 months now.
Sure, sir. That's it from my side. Thank you so much.
Sure, sir.
Thank you. The next question is from the line of Manan Vandur from Walford with PMS. Please go ahead.
Thank you so much. Thank you, sir, for the great
Sure, Manan, please do.
So I have one question. Is it about our capex which we have done, and you also said that
I think I lost the connection.
The next question.
Yeah, I can hear you, but I lost the connection from Manan.
Yeah, so the next question is from the line of Kunal Tokas.
Hello, sir. Am I audible?
Yes, sir.
Yes, Kunal, please go ahead.
Okay. So I believe we have a kiln capacity of 1.8 million tons, and you have planned for the future, so you have made it higher than the cement capacity. So my question is, sir, if we want to increase the cement capacity, which the kiln can support, how much additional capex will it require?
So basically, the correct way to put it is, currently the kiln is of the capacity which can produce about 1.8 million tons of cement, slag cement, basically PSC cement. So Right now, we will be underutilizing the kiln because to overutilize the kiln, we will have to add the crushing capacity. And once we add the crushing capacity and the kiln capacity, the machine is ready. It is just that we have to have an ability to feed higher quantity. As such, we have enough to feed right now with the current project to reach about 1 million ton cement capacity, what has been projected for this CapEx. Now, to reach 1.8 million tons, all that I have to do is add more crushing capacity and then more grinding capacity, of course, to make sure we reach 1.8 million tons. The best part about it is we don't have to change the kiln, the cooler, nothing. We just have to add an additional machinery on either side, for which the land also is available, and the power what we will receive now also is sufficient to take care of that CapEx. So that we will be taking up, once we stabilize this existing plant for at least to around 65 to 70% capacity utilization.
So by beginning of FY27, I believe?
Timing would be hard to guess. Assume that FY26, FY27 goes off. Maybe the most optimistic will be around FY28.
FY28.
Yeah.
So you're implying that by FY28 only you will be able to get to 60-70% capacity utilization of this 1 million ton that you have put up?
Yes, as per what we have reported to the banks and everyone, that is the target we are achieving. Not necessarily that we will have to wait for that long. 1 million ton is not a huge capacity for us, which will face a significant challenge. The company is poised, in fact, to try to achieve that 70% as soon as possible. But realistically, it might take maybe a year and a half to 2 years.
And compared to the capex that you incurred to put up this 1 million ton capacity, compared to this, how much more capex would be required to go from 1 million to 1.8 million? I mean, if you can give a relative proportional number.
So as on today's cost, it should not take more than 100 crores to do
You
so.
already have the kiln, right?
Correct. But still, we will have to, let's say, we have an existing crushing section. Another crusher we will need to make sure that we feed enough into the kiln. And another grinding equipment, which will maybe around 80 to 100 crores. But that's a guesstimate which I'm making. The realistic figure will happen once we do the engineering.
80 to 100 crores. Okay.
Yes.
And so because of this unutilized kiln capacity, are you incurring any significant fixed costs or to maintain this capacity or no? Something that might be dragging down your P&L?
No, not at all. So these kilns are fit for this capacity range what we have discussed. So only thing we're using the lower end of the capacity. Otherwise, if I have to stick with the lower end of the capacity, this kiln will continue to be a suitable one.
Okay, sir. And after you reach an optimum utilization for the 1 million ton capacity, will you be utilizing your entire output from the solar assets?
No, maybe around 95%. About 36 megawatt we will utilize. Still 4 to 5 megawatt will continue to remain spare.
4 to 5 megawatt will continue to remain to be sold in the open market?
Sold, correct. Yes.
Okay, sir. I guess that were my questions, sir. I'll come back if I have any more. Thank you.
Sure, Pran. Thank you.
Thank you. The next question is from the line of Manan Vandu from Wallfort PMS. Please go ahead.
Yes, sir. Can you hear me now?
Yes, Manan, I can hear you now.
Yes, okay. So the first question was that even as you said that there was some delay from the government for the power thing to come in. So even as you said that it might take around a month to come in.
Yes.
So can we expect full ramp up by January?
Absolutely.
Of course, not the whole capacity utilization, but the start of it.
Absolutely. See, in fact, there is a station known as Chandrakute Banu station, which was supposed to come up close to our existing plant, where we were supposed to draw a 110 kV line. And these substations are not very difficult to make. It's just couple of months project for the government. It was supposed to come up about 6 to 8 months back. but then there was some kind of a delay which got set in and, they say by mid of December it should come up. The moment it comes up, they'll throw a line to us. So once that comes up, great. Otherwise, they are working on to provide alternative to us, which means on existing line, they will increase the capacity and allow us to use to certain capacity where our entire plant can run. But for now, we are waiting for that thing to run. But to address your question, yes, in all aspects, January will be the month where we will have a higher capacity to operate.
Okay, got it. And there would have been a drop in production, right, due to the plant shutdown, because we would have shut down a plant for some time so that the additional capacity would have come in.
So, typically what is happening is even though we are, our production utilization is, as we showed, is less, but it is less because of the less sales. It is not that the kiln is giving less production. So as of now, what we will be doing is, once we are closer to operating the new kiln, we have to make some hookup, like, change the feeding from old kiln to the new kiln. So when that comes, we will be doing that. But then there will be a 15-day shutdown, and we will have enough clinker to grind cement and sell it. So there won't be any disruption in the dispatches, if that is the question answer you're looking for.
Yes. Okay, so that shutdown has not happened yet.
No, not yet. So we will take a shutdown 15 days before the hookup is going to take to the new kiln.
Correct. So, and the last question is, sir, around how much volume was sold in this quarter and is compared to the same quarter last year?
Definitely. So this quarter, you want quarterly figures or H1 figures?
Quarter figures, sir.
I'll give both if you want. Like, quarter is around 52,000 this quarter compared to 49,300 in the earlier quarter of the previous Q2. If you look at half yearly, around 115,000 tons compared to 105,000 tons in the H1 of FY24.
Okay.
Now, biggest issue is that compared to H1 of FY24 to H1 of FY25, the price has reduced drastically by around 11-12%. Even though dispatch they increased by around 10%.
Right.
So this is what I would be telling you. Even in this bad market, if we are able to reach higher dispatches and more taking to market share, because we increase the number of sales force and other things, I'm pretty positive that once the market opens up, there is going to be a very good trajectory that we're going to look at.
Yes, right. That's it from my side, sir, for now. Thank you so much.
Perfect. Thank you.
Thank you. The next question is from the line of Yashwanti Kojan from an individual investor. Please go ahead.
This is Yashwanti from Kojan Finance. Sir, I just wanted to understand, how our EBITDA margin is moving on. So last year, for the whole year, we recorded around 32%, a great increase from 264 basis point expansion. Then Q1, again, it has come down to 26%, and now in Q2, we have seen it 12.44%. I'm sorry if you already explained it in your opening remarks because I couldn't join in that time. But what kind of an outlook as an investor we can foresee going forward?
Definitely. So the concern is on the EBITDA margin is what I understand.
Yes. So from 32% to 12% in sharp decline.
Yes, it is very, very less compared to what we reached in the region of 30s in earlier quarters like Q1, Q2 of FY24. There's no doubt about it. But unfortunately, EBITDA becomes a derivative of the pricing. Typically, most of the raw material prices have either remained intact or they have risen, in trend with the inflation. But the pricing going 10% has impacted EBITDA drastically, which is why the EBITDA margins have gone down. The only reason whatever EBITDA we have got, which is what you see, is basically because of our intact solar vertical, which has remarkably shown the production also increasing as well as the pricing remaining stable, which is the nature of that particular industry. But if the prices continue to grow like what it has been anticipated by top analysts, we will see the EBITDA margins coming to around in the 30s figure very soon. And then with the new capex, we should be getting close to more than 35 to 36%, as the whole project is based on the objective of reducing the variable cost.
Oh, but then, what kind of a timeline do you expect for going back to 30 or 35%?
I'm hoping if the price increases as predicted by analysts, we should reach it as soon as in Q4 itself. There's no reason why we should hold on to that.
So is the price dip is seen only in the Karnataka because we have a major presence over there, or it is across India?
No, typically, if you look at all the cement, typically this has been seen nationally. South is more impacted, definitely, yes, because there are larger plants here. But typically, this has been a national character if you look at all the cement plants too.
And sir, in case the price remain at the same level or it further dips down, what kind of a pressure we can see on the EBITDA margin? And is it going to compensate by the solar contribution?
So even in spite of having these kind of bad pricing, it is the solar which is kind of making sure cash, cash is building up to take care of all other expenses. But nevertheless, we have seen the price plateau from the, by mid of September or beginning of September, we've seen this price plateauing. It has not gone on any further. So we know that this is the bottom what every cement plant can go, beyond which there is no scope for anyone. So it's just a matter of time before which it start taking upward stage. And even if it has to delay, for our company, we have a strong solar vertical which will definitely lead us to this period of short-term crisis.
Sir, in H1 profit, EBITDA of around 11.11 crore, what is the solar contribution coming to it?
What is coming to it? Solar component?
Solar contribution EBITDA.
Contribution of solar in H1, is it?
Yes, in H1 of EBITDA. So EBITDA reported around 11.11 crores, of which how much is coming from solar and how much is coming from cement?
Okay, just give me a minute here because I think 11.11 crores was mentioned for
H1.
H1, right?
Yes.
So, all right. So out of all right. So typically, solar EBITDA is around, I would say, hold on, give me a minute here. The solar EBITDA is around 14 crores and the cement EBITDA is negative, which is why we have seen 11.11 crores.
Okay. And in case of third quarter, what was the price in the November, the current month we are seeing in the cement, and what was in the first quarter of the current year, cement prices?
You're talking about quarter one FY25 or FY24?
Yes. I just wanted to know, what is the current ruling prices, maybe at November or maybe at October end, what you are witnessing in Karnataka, because this is the place where we actually get our dispatches of the cement. And what was the price at the start of the year, that is the first quarter of the current?
So quarter one, the price is around 3,480 rupees or 3,470 rupees in quarter one. Quarter two average is 3,290. So we are seeing 3,300 range in October as of now. October and even November. So it has kind of plateaued since last 3 months. We're just hoping to get it back to normal. For example, last year the average price was around 3,800. Even if you add another 500 rupees to the top line, your EBITDA will, will add another 15 crores to the EBITDA for us. For around 250,000 into 500, it will add around 12.5 crores EBITDA, which we lost due to lower pricing.
And what is the likely chances that our EBITDA may move from 12% from what has been reported in the Q2 to what extent it can go down? It is very unlikely, but in that case, what can be the fall we can expect?
Likelihood of going down does not appear to show any signs right now. Like I mentioned, last 2.5 months, there has been a plateau in the cement pricing. In fact, anything we see, there could be a little increase, but not below this. All that I can say is if the top analysts predictions come to regarding cement, the cement should see in the range of 3,700 to 800 in Q4. But that is something what analysts are talking about. We are not sure how it actually will pan out in reality. So if the prices continue to be like this, we will be in the range of 12% EBITDA. We will continue to be in the range of 12% EBITDA.
Okay, so that is the where we can see at least it will not fall down from the 12%. That is really good. And how has been the coal and the paid coke? Because we shifted to the paid coke thing because the coal prices were higher, but then after shifting, we also seen that the paid coke prices were also higher. So how is it seen? Are we seeing any improvement in the paid coke prices?
Petrol pricing have reduced little bit last month in October. Otherwise, in Q2, the petrol pricing were pretty stable. But if we compare to previous years, of course, it has come down not very significantly, maybe a little bit. But overall, if you look at all the other raw materials, the increase in the cost of other things have grown up with the inflation. But petrol price have relatively remained same. We are hoping that petrol price will continue to go down now because last 2 months it has shown price going down.
Okay. And sir, any debt repayment we could do it in the Q2?
Yes, we have the regular debt payment around, I think quarterly debt payment is around 6 crores, which we have continued to service it on time.
Okay. And for my last question, as we have seen there's a difference in cement prices, so are we halting our expansion plan or it is running on the time?
No, the expansion from our perspective, from the point of project perspective, we have completed the project. Something which is external to our condition is holding up the commissioning. But nevertheless, we have got assurances from the department that most likely by mid of December or maybe at the most end of December, we should be through with that. And they have also assured us in case it is getting further delayed, they will provide an alternative arrangement in the existing line itself. So both the discussions are going on.
Okay. And what is the current capacity utilization currently, maybe in the first half or maybe at the end of the November?
So I can, for example, compared to H1 of earlier and compared to H1 of now, there is an increase. But I can give you, in Q1, the capacity utilization was 69% and Q2 capacity utilization was 57%. But if you look at the Q1, Q2 of FY24, capacity utilization was 62% and 54%, which has increased to 69% and 57%.
Oh, okay. Thank you, sir. I'll join back and do and all the best for the coming call.
Sure, sir. Thanks a lot.
Thank you. The next question is from the line of Tunar Vasudha from Yoga Capital. Please go ahead.
Hello, am I audible?
Yes, sir,
Yes.
you're audible.
Yes, sir. Thank you for the opportunity. I have a couple of questions. So recently we are seeing even more consolidation in the south, and we did talk about it in the last call. So has there been any update in that? Has it been approached by someone else or something of that sort?
No, I could not hear the last part of your sentence. Come again.
So has any other bigger player approached you or some deal or some terms or something of that sort?
No, not right now. We have not have any kind of direct request from anyone so far.
So would you be willing to sell or would you be open to that?
I would say as a cement division, if there is something which is going to come in the perspective which will help improve the shareholders' wealth, yes, the management will always look at it in a positive manner. In fact, there are some opportunities since our plant is located close to the consuming market, we provide certain advantages what major plants do not have. So if those things pan out, there are possibilities where some major plant might come to us to do some kind of white labeling for their product, which is definitely a possibility. But that would happen once our plant gets 100% commission, and then we would take the discussion to the next level. But that is something which we feel could be a good, plan out to utilize our capacity for the first couple of years, where, our own brand capacity utilization will be around 50 to 60%. That's something management is thinking of.
Okay, sir. And so you previously mentioned that your region has an annual demand of about 30 million tons, and with the capacity serving that region being around 6.5 to 7 million tons per annum. So is the supply demand gap still there? Because I'm not able to wrap my head around the fact that around these numbers, because it's such a sizable demand supply gap that it should invite new capacities in the region, right?
No, definitely, yes. But then, what I mentioned was, say about, I must have mentioned about 350 kilometers radius. So that comes, like almost a significant portion of South Maharashtra, significant portion of North Karnataka. By that population density, the projection was around 30 million, because average consumption of cement on per capita basis in FY24 was 260. So assuming about 280 now, that is the kind of outlook. So what I meant to say was, we were very close to these areas compared to the major plants. But there are major plants who would be still supplying in our areas. So what would mean that the kind of location advantages we had, the major plant would not have that. So having said that, with the kind of sluggish cement market that we are seeing, a lot of major plants are cutting down on the pricing and reaching all the way to, the areas that I mentioned. So let me give you an example. The tier 1 brand, which was almost selling at, almost upwards of 410 rupees. If you remember last year, these prices, they are selling at around 300 rupees right now. When you say 300 rupees, I'll tell you how it pans out. So 300 rupees, if you take off the taxation, the net realization becomes 234. And for the major plants, they spend about 50 to 60 rupees as the transportation. So they are getting a net realization of not more than 3,400 to 3,500 as of now. For example, let's take an example, Goa. Now, for one major plant for the closest major plant for Goa, for a tier 1 brand is around, say 500 kilometers. And based on our discussion with the logistic firms, the logistic cost is around 1,900 rupees. So if you're selling cement at 6,000 and you take off the taxes and take away 1,900, you are, let me give you an example here. So they are selling cement almost at the naked cement price in the range of 2,800 rupees to reach the 300 rupees pricing per bag in place like Goa, where we are getting much higher naked cement price because, again, we are closer to the Goan market. Our transportation cost is like around, maybe 800 to 850 rupees compared to theirs about 1,900 rupees. So having said that, because of the sluggish demand, there is a lot of rush from other areas coming here and selling, but once that will evaporate the moment there is some kind of expenditure coming from the government and also, housing sector. So everyone will go back to their, original home markets, so that everywhere there is going to be an uptick in demand for producers like us.
Okay, so you explained the fact that so for tier 1 players to sell in Goa, they have to spend a lot more than you. That naked cement prices are way lesser than you. So it should attract more capacities and more capexes in your area. So are there any current major capacities or something like that going in the region around Goa, Maharashtra, and Karnataka?
No, I think there was some disconnect. So come again with the question, please.
Yes, sir.
How would it help us?
Hello?
Yeah. Please go ahead, Kunal.
Yes, sir. So as you mentioned that for the closest tier 1 plant to Goa is around 500 kilometers away, and we have more trade advantage. We have more advantage compared to the tier 1 plant. So it should attract more plants to come up in the similar area to better serve that region, right?
I got it. So it is not technically possible because we have a small capacity of 1 million ton. Maybe 1 million, 2 million tons that in limestone belt area can have. Maybe there are about 2 other plants there, like for example, which is having a capacity of 2 million tons. There is not really so much of, it is not a limestone belt where the larger plants can have like 10 or 15 million ton capacity. So if you have to have a capacity of that large size, they have to go to the, nationally available mine space, which in Karnataka is Gulbarga. For Rajasthan, it is like near the Beaver region. Even in Andhra Pradesh, it is Tandu region. There are very places where dense cement plants are there. For example, Gulbarga might be having 30 plants over there, all located within 20, 30 kilometers radius, or maybe like 50 kilometer radius. So it is not possible for very, very large plants to come in my area. In fact, we ourselves cannot expand to a size of 10 million ton in the existing capacity. So that disadvantage is there for that location. For a small capacity like us, it will work out.
Okay, sir. And sir, coming to the solar business of your solar part of the business, so what was the per unit cost of electricity that you sold in Q2 FY25 compared to Q2 FY24?
Yes. Q2 FY25 to Q2 FY24. So in Q2 FY24, we sold average selling prices around 6.36 rupees. Now it has come down to 6.09 because in Karnataka, the price of power has been reduced by 50% because of the sudden election promise. And it is hoping that this will, there is a realistic expectation this price will go up again in April 2025, which is when there is going to be an uptick in solar pricing too.
Okay, sir. And so the current capacity expansion that you guys are doing is...
Sir, excuse me. For follow-up questions, can you please rejoin the queue?
Sure. Thank you.
Thank you. The next question is from the line of Kunal Tokas from Fair Value Capital. Please go ahead.
Hello, am I audible?
Yes, sir, you're audible.
Okay. First, just two quick questions. First is, you said that your guidance for FY26, EBITDA guidance was based on cement prices for FY24. Now, cement prices have fallen a lot, and if they stay at 3,300 for FY25, how will that affect your EBITDA and that guidance for FY26?
So assuming that the price what we have will continue to remain as it is.
Yes.
So, of course, then we will not be able to reach the 100 to 120 level that we projected based on FY24 figures, and then the, price increase at the range of 3%. So at 3,300, then you're talking about a EBITDA level of around maybe just a rough calculation, taking off around 700 rupees out of your pricing would mean at 50 or 60% capacity, maybe the guidance will be around 60 crores. It will still be higher because once the new kiln starts, we will have a better production and production at a lower cost, because the whole idea of this capex is to reduce your fuel consumption, power consumption. So assuming 3,300 is the price that will stay in FY27, we're talking about a bit of around 60 to 65 crores. Almost 50 crores will be shaved off just because if we assume that there is no price at that time.
But you also have some operating deleveraging, right? Because
much higher operating leverage. Because once my price of production goes down, everything else, because with the better cash flows, we can do better marketing, sales, improve, and try to recapture or rather capture the market share.
And this plant, I assume, will be depreciated on a straight line basis?
The cement plant?
Yes. So I'm trying to get down to the PAT figure from the EBITDA figure. So how much would you say your interest and depreciation expenses would be for next year? Because you have the debt and you have the property, plant and equipment figure right now.
So, okay, I'll try to break down this and answer in a couple of points. So if EBITDA is supposed, even with these prices, the EBITDA reaches around 60 to 65 crores, my interest plus repayment will be around 40 crores, 40 or 40 to 42 crores. That is the projected based on our repayment structure. And the next question you asked was for
depreciation.
Depreciation will be on straight line for the sake of book depreciation. Yeah, the point what I wanted to mention was we have around 90 to 100 crores carry forward loss in the income tax books, which means that at least 3 to 4 years we will not have regular income tax. So we are hoping that next 4 to 5 years we will continue to pay income tax at the MAT level. So that is going to be an additional saving, or rather, advantage this balance sheet would have for next 4 to 5 years.
But what was the figure that you mentioned, sir? I missed it.
Since we have invested in solar, there is almost 90 to 95 carry forward depreciation loss in the income tax books, which is why next 4 to 5 years we may not have actual income tax rates to be paid. So we will continue to pay on a MAT level, which is 15% for next 4 to 5 years.
Okay. Understood, sir. Thank you.
Sure.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Jainam Savla from Kirin Advisors for the closing comments.
Thank you everyone for joining the earnings conference call of Shri Keshav Cements and Infra Limited. If you have any queries, you can reach us to at research@kirinadvisors.com. Thank you everyone for joining the conference call. Thank you.
Yeah, thank you everyone. Have a nice day everyone. Thank you.
Thank you.